Good morning, and thank you for joining us today on Tax Tuesdays, where we do deep dives into corporation tax issues and topics. These corporation tax topics are geared up mainly for accountants, accounting firm owners, entrepreneurs, if you like to go into the depths of corporation tax as well. But we also do encourage accounting firm teams to attend as well, because it will help you really understand corporation tax in a lot more detail. We have experts such as Rashmi. Rashmi is one of the best or the best not accounting, but tax expert in Dubai. And I go to her for a lot of my advice as well to understand tax, because she thinks about, once you give her one question, she thinks about it in like 10, 15 different ways. And my brain can't handle 10, 15 different ways. So so that's why I recommend her. And that's why, we honored to have her on a regular basis. Today, we will be talking about tax groups, quite a deep subject. For many companies, that's actually quite a important topic, because whether you know it or you don't, maybe you might have clients, or maybe you might have a tax group, but you haven't registered as a tax group, or there's a number of transactions happening. Maybe your boss or the entrepreneur, for whatever random reason, they just set up trade licenses because they just get excited about a new business, not thinking about the fact that you need to group, or there's a group considerations that you need to put into consideration. And I love it when entrepreneurs come to me and they've literally 5 new trade licenses without even telling us. So just something for you to food for thought. Rashmi, do you want to give us a quick introduction about yourself, about JRB?
Thanks, Rehan. Good morning, everyone. I have been practicing tax for 20 plus years, and that's all I want to say, that I like reading tax, and it's a super interesting. As you say, it's interesting because it has its own logic and it has its own flow and its connection points. So yeah, so that's what I like about tax. And when it integrates with accounting and audit and requirements, it makes a lot of sense for JRB, where we provide a full suite solution across. So all the boxes that you need to tick to be compliant, as we have highlighted many a times, it's now, because it's corporate tax, it's not just corporate tax, which starting point is your IFRS compliant books. So your books and your audits become important as well. So yeah, JRB, we try to help you with everything you need in and around, other than the technology which comes from you.
Thank you very much. Am I right in thinking that you started reading about tax from the age of 3? Because you said you've been doing it. So
Okay, that bit should be recorded, please. I'll be using that.
cool. I'm going to add the corporation tax slides now. So yeah, so I'm super excited to learn more about tax groups. I'll also chime in whenever I've got something relevant to say anyway. But the floor is yours. So thank you very much.
Yes, thank you, Rehan. So now today's topic, I am super excited because it's not that this is applicable to a lot of people, but when it gets applicable, there are a lot of things that need to be seen, and everyone who is practically thinking of going for a tax group should be aware that all the requisitions and the compliances they will need to do. Just today, I think yesterday, as I clarified, there is a new clarification which has come in, wherein there will be an additional requirement for tax groups as far as their audits are concerned, which was always, there was an ambiguity in and around it, and we will cover it as we cover this, that what was the ambiguity. A partial thing about that is clarified, and then we will see how further we need to look into the clarifications coming in for the tax group purposes from the audit angle and the compliance of books of accounts. But before that, just going through the basics, the definition, the requirements, and then we will go into the implications of when you have a tax group, how it will impact. So we'll necessarily be covering the Article 40, the Ministerial Decision 125, and the tax group guidelines all together in this presentation. So
I just want to add thing.
Yes, please.
I love the way you're able to refer back to the ministerial decision and the actual, actual article as well. So just thought I'd
Thank you.
give you that compliment.
Okay, thank you so much. Yeah. So now I'm just hoping that I quoted them right now that you've highlighted. Okay, so starting with the tax group definition, we know for forming a group, you need to be more than one person. So it has to be two or more taxable persons to be forming a tax group. I just want to first go through the concept and then I'll go into the definition. What will happen if you form a tax group? If you form a tax group, that means you will be filing one tax return. So you will be consolidating your numbers and then you will file the consolidated P&L balance sheet will become your one tax return. What does that impact is that your intergroup transactions get nullified. So if A is selling to B and for B it is becoming the purchase, that gets nullified. And the benefit of that is one of the biggest benefits, if I have to say for forming a tax group, one of them is that the intergroup transaction, because they get nullified, in most of the circumstances, not 100%, you don't need to do any transfer pricing compliances because they get nullified. Then these are our related party transactions, right? These are group companies, these are parent subsidiary. So because they are related party transactions, you do not need to do transfer pricing compliance because they will be net off when you are going to do the reporting. So that is one of the very huge advantages for companies who have a lot or materially high value of intra-group transactions. It is also that if a company is forming a loss and the other company is a profit, when you're filing the return, you don't need to do the carry forward and net off of tax losses. It actually gets netted off in the calculation itself. As we had seen in the tax losses previous presentation, that there are restrictions, right? You have to first adjust it against your profit. So if you have till 375,000 profit, you don't get the benefit. You can only adjust 75%, etc. But from a tax group, it gets nullified by itself and you don't need to. So it gets offset while calculating itself. You do only one if you find the tax group. So now let's get into what do you need to hold or what are the conditions to comply with the tax return, tax group forming requirements. Next slide, please. Rehan, next slide. Yeah. So these are the 8 mandatory conditions as per Article 40. No, one before. Yeah. So these are the 8 mandatory conditions. Super important to note that all the entities forming part of the tax group have to be juridical persons. So an individual, natural person does not qualify to form part of tax group. The second condition is that you have to be a UAE tax resident. We will dwell into a little more conditions of that. That if you, what does it mean that you are UAE tax resident? It says that you cannot be a tax resident anywhere else, and it will require you to give a proof that you are not a tax resident. So if you're formed outside and you are UAE resident due to your POEM or place of effective management or control or whatever, if that is the basis, then you will have to get a certificate that you are not a tax resident in any other foreign jurisdiction. So you have to be a juridical person, you have to be a UAE resident, you need to hold the 95%. So there has to be a parent subsidiary relationship and the parent should hold at least 95% of capital, voting rights and rights to profits and net assets of each subsidiary. So it is 95% or more of not just the share capital, not just the voting rights, but share capital. And there is a clarification in the ministerial decision 125 that the share capital has to be the paid up share capital. So, and 95% plus of the voting rights and the 95% plus rights of the profits and net assets of each subsidiary. None of the parent or the subsidiary which is forming part of the group can be an exempt person. None of them can be a qualifying free zone person. And all of them need to follow the same financial year and the same accounting standards. Now, financial year, if one, yeah, tell me.
Just can we just expand on exempt persons just for the, just for the audience?
Yeah, so there is one exception to the exempt person, but then all the exempt persons through the qualifying activities. So you are in extraction, you are government bodies, you are one of the charitable organizations which have been exempt. So there are 8 to 9 exempt persons definitions given. And if you are one of those companies which are exempt, then you cannot be forming part of the tax group. There is one exception here, though, where a company, if but then we'll go through that detail once we get to the part where only one exception, when partial part of exempt person can become at least a parent of the tax group. But other than that, no other parent or subsidiary can be an exempt person. Any of those categories, if you're doing extraction business, or if you're doing any government, if you're a government body, or if you're doing charitable, or those activities which are defined under exempt persons.
Okay, now got it. Thanks.
Right. Okay. So you have to follow the same financial year, and your accounting standards have to be the same. As I've clarified again, accounting standard means IFRS SME, then IFRS SME for all, IFRS full, so IFRS full for all. So if you're looking at forming tax groups, even if one of the subsidiaries is too small, I encourage that you go for a full IFRS compliance, so that all entities have the same reporting structure to have the consolidation done. And your financial year, if it is not the same and you intend to form the subsidiary as a part of the group, FTA has clarified that you can make the application of changing their tax period, and your first tax period accordingly will be either more or less to adjust, which is between 6 months to 18 months. And then the adjustment can be made to align, but this is an application to be made to the FTA. So these are the preconditions. Juridical person and UAE tax residence is super important to remember as far as tax residencies is concerned. And I will dwell on this 95% condition a little more, because this 95% ownership can be direct as well as indirect. So we have covered certain examples to clarify what this owning structure would require. But again, to clarify, if you have a holding company and you have the subsidiaries, the holding company as well as the subsidiaries all will have to be UAE resident, and all will have to be juridical person. So if a foreign company has a lot of subsidiaries in UAE, they should consider opening another layer of a holding company within UAE, so that that holding company parent UAE can form a tax group with the subsidiaries, and then there can be a next level consolidation. So yeah, going forward,
I think that's a good point, because if you're a multinational organization, even within the UAE, you may have multiple tax groups, right? You might not just have one tax group, you might have like 2 or 3 within your kind of group of companies.
yes. So, and this becomes important if if you have a lot of transactions, you need to do a lot of compliances, and you want to be forming part. If one company has a loss and you're looking at any benefit, then you need to see that you can create this is the solution available to create, even if your parent actually is sitting outside. Yeah. So this I would highlight here, because of this 95% threshold, one thing that should be highlighted, and I think all the accountants and we in the practice do understand this challenge now, that you would be holding 95% and only that can form a tax group, and you can only have the consolidation for tax group purposes for the parent and companies having 95% ownership. However, according to IFRS and accounting, you would be doing consolidation if you own 50 plus percentage of any subsidiary. So you would be doing a consolidation for subsidiary if you have a 75% holding. But for tax purposes, that will not be the case. Also, for IFRS, you do the consolidation even if you hold the management and control rights. But then in case of taxes, you need the legal ownership also. So it is important that you need legal as well as the managerial control. If you only own the legal and you do not own the managerial, then also you cannot form the tax group. So you need all the rights as far as tax groups are concerned. So therefore, entities will have to prepare separate special purpose audit reports as far as the taxes concerned. If your tax group is different than if you only have one subsidiary which is 95% plus and it aligns with your main consolidation, then it's okay. But if there are subsidiaries that you are not consolidating for tax group purposes, but for your normal IFRS purposes, and that's what the clarification in the new decision that has come out, that they will come out with detailed rules, but they have said that the tax group will have to prepare a special purpose audited financial statements for your tax group purposes. So because your audited consolidation might not reconcile with your tax group numbers. So they are different. So they have said that there will be a special purpose. You cannot have two same consolidation audits. So it will be a special purpose audit that the tax group will have to conduct. More rules and clarifications are still awaited on that. So that's something super important. Practical side of it, what happens? If you have to prepare that consolidation for 24, you need to have the opening balances of that balance sheet to prepare the consolidation for the 24. So the groups should start extracting, and their systems, their accounting systems and the systems that they're following for tax reporting purposes should be able to give them that data, because many group companies might be just nullifying. If they are doing IFRS based consolidation, their systems might be preset to nullify all their intercompany transactions. But because they are not tax group for tax purposes, because they do not qualify for tax group, when they report for taxes, they cannot nullify or offset these transactions. So the companies should look into how their reporting is automated and how that information can be extracted for tax purposes. Now, going to understanding the threshold requirement of 95%. So 95%, I've clarified that it has to be nominal as well as paid up share capital. It can be direct as well as indirect. And what you have to have the voting rights as well as the right to the net assets. I think if you can go to the next slide, I will clarify the direct and indirect. Yes. So indirect ownership, if the company A owns more than 95% or a percentage of company B, so parent company owns 95% of company A, which owns 95% of company B. Effectively, parent company only owns 90.25%. So it will do 95% of 95%. So the effective ownership of company B for company A, parent company, is only 90.25%, which is below the threshold. So parent company can form a tax group with company A, but not with company B. So it has to be at every level taken what is the parent company's ultimate ownership with the tax group companies. So even if your subsidiary owns 95% plus on some other subsidiary, sub-subsidiary, parent company cannot consolidate unless parent company effectively owns more than 95%. So if you see the second example, in that the parent company directly owns 50% of the subsidiary, 50% of subsidiary, and owns 95% of another entity that owns 50% of the subsidiary. Okay. In which case the threshold is met. However, I have to clarify again here. So let me take a step back and I'll again clarify three conditions here. They are super important. So a parent company directly owns 95% of a company, so 95% plus of subsidiaries. Super clear. Parent plus those subsidiaries can form a tax group. A parent company owns 95% plus of one company and 95% plus of another company, which owns other company. Then you can own if effective ownership of parent company till the extent of the subsidiary stays 95%. If the subsidiaries effective percentage held by parent is below 95%, that cannot form part of tax group. However, that does not restrict the subsidiary to be forming part. So till whatever, so you can select all the subsidiaries where the 95% condition is satisfied, and all those companies can form part of the group. One person can only be, one juridical person can only be part of one tax group. So if in the above case, in the first example, if you see that the parent company and company A are forming part of tax group, then company A and company B cannot form another tax group. So company A can be part of only one tax group at a time.
Yeah, so I was going to ask you that question. Can you have, in this situation, can you have two tax groups? But you've already answered it, so thank you.
Yeah. So in qualifying group, you can be part of multiple qualifying groups, but you cannot be part of multiple tax groups. However, if we add one more layer there, so in my first example,
I'm just going to pause you. You made a distinction between tax group and qualifying groups.
Yeah.
What's the distinguish between the two? Just to remind the viewers as well.
So qualifying group is when you do not qualify to form the tax groups, but you own, there is a common ownership of 75% plus between companies. You can choose to transfer your tax losses and utilize your tax losses amongst your qualifying groups companies, there the
Yeah.
requirement is 75% plus, and still you can at least take the benefit of offsetting your losses and some other benefits that you can take if you qualify for business restructuring group and other things. But then as far as losses are concerned, you can take that benefit, which cases where you cannot form the tax group. So you
Okay.
can be part of multiple tax qualifying groups. So, but then tax group, only one.
Okay. I got you. Thank you for clarifying that.
Thank you. Yeah, so going back here, in my first example, as I said, that company B, if owns a subsidiary, 100% subsidiary or 96% subsidiary C, because B is not forming part of our main group, which is parent and A, B and its subsidiary C can still form a tax group. Because B is not part of the parent, B becomes the role of the parent company, which owns a subsidiary C, and then B and C can form a tax group, and parent company and company A can form a tax group. We are presuming all other conditions that they are in UAE, all other 7 conditions, or sorry, 5 conditions are qualified here. Then the 95% calculation will come into play. Also, I've not highlighted here in the example perhaps, but it is also important to note that at every chain level, the qualification of 95% has to be maintained. If at any level, if I own 80% of a company which owns 100% of another company, I cannot have the third company unless the chain passes through everyone which is becoming a qualifying subsidiary. If in the chain any one is not qualified for 95% qualifying entity, then its subsidiaries benefits I cannot take. Its holdings of its subsidiaries cannot be taken by the parent company. So the calculation, if you have multiple percentages and they are not 100% subsidiary calculations, so there should be a proper calculation done of what will qualify to become the forming part of the tax group based on your direct and indirect ownerships. And if at any point in time your ownerships change within 20 working days, the FTA authority should be notified, like any other updates that we are giving. So it's important that within 20 days, the FTA has to be notified of those changes. Moving on. Okay, so now if we're clear that we know the conditions, we have seen that 95% calculations are done, and we know which entities we want to form group of, then the joint application by the parent company and each subsidiary. Application must be submitted before the first, so we have to submit the application before the first tax period's end, and the tax group will receive a separate TRN. The parent company, so other jurisdictions, sometimes they give you an option that you can select one of the companies to become the representative company, but here it has been made compulsory that the parent company will play that role. So the representative company can only be the parent company. There is no option given to select or choose which company will become the representative company. What is a representative company? Is the company which will actually prepare the consolidated financial statement, file the returns, and be the point of communication between the authorities. And so that is the representative company, will only be the parent company. However, the liability of the tax and penalties are jointly and severally being owned by all the companies. So it's parent company is only the representative company. The restriction, the liability is not restricted to the parent company. All the member companies of a tax group are jointly and severally liable for all the group's tax liability and penalties. So that's something that needs to be considered. Moving on. Tax group income calculation remains the same after you have reached the consolidated numbers. That is, your intergroup transactions are eliminated, and then you have your normal financial statements prepared. As we have said, that we have to have single accounting standards followed across all the companies, and if at all there are any transactions which do not form part of the netting off, that is, you have other related parties which have not formed part of tax group and therefore their transactions are not offset, then the arm's length standard and the transfer pricing regulations have to be complied with. If I have to summarize what are the benefits, you can take the tax group, you can offset the losses, you can have lesser burden of TP if you are offsetting your transactions. But what is the flip side? And another benefit, what are the flip sides? If you want to take a small business relief, whole tax group's turnover will be taken together. So it's very unlikely that you do not cross the 3 million. Individual entities might get that benefit in initial years. But then if you form a tax group, the total, all the limits will apply to tax group as one. So your 50 million limit for getting your audited financial statements, your 3 million limit for your business relief, they will all apply at the group level as one single entity. The 375,000 also, you will get it as one. The base 375 after which you apply the 9% is one for the tax group. So the tax group is treated as one entity, not based on the number of entities.
Sorry, just a quick question. Going back
Sure.
to the previous slide, there could be a lot of businesses who don't realize that they could form a tax group, right? And it's too late, and they got to do their first return before the end of 30th of September this year because they have their tax period is calendar years. In that situation, I assume that they cannot apply for a group. If they do, they'll get a penalty. And what their mechanism will be is to do the tax as a qualifying group rather than a tax group.
Yeah, if they want to take the benefit of losses for the first year, yes, they have missed the deadline, so they cannot form. They will get the penalties if they have to apply for the tax group. But then you do not lapse the benefit at the end of. So you can still form it for the second year. So it is for each tax period that the timeline is there. This is not the selection that you can only make in your first returns, and it's a moving target, right? Some companies will form part of group, some will leave the tax group. And so every year end the assessment has to be done again and the application therefore can be made accordingly. But if you miss the timeline because you still qualify for the qualifying group relief, you are more than 75% holding beneficial holding, so you can still take the benefit of the qualifying group reliefs that you have, the business restructuring if you want, or whatever applies to you, especially the losses part. I think we do not have the slides on the screen.
Slides. So
no worries.
Give me.
I can talk.
Yeah. If you want to carry on, and then I'll get the slides in about a few minutes.
No worries. So the next topic that we were to cover, that we are supposed to cover, is that what happens if there are tax losses and the companies form part of the new group or they leave the group, and therefore the importance of making separate financial statements. So there are few things that will always continue entity level and will not get merged with the group benefits even if you form the tax groups. And therefore, in those cases, you will need to continue making separate financial statements. What are those cases? So if company A has tax losses before it formed the group, that is the tax loss, what is the period they state? From the start of the tax period when the loss was incurred till the end of the tax period in which the loss is to be utilized, the company should be forming part of the tax group. If that condition is not qualified, then that tax loss remains attributable only to that company. So if company A joined the tax group, say in the year 2026, and it has a tax loss for 2025, it cannot take the benefit of a slide before. Yeah. I think the tax losses are before this or after that. I don't. Okay. So I'll continue. Tax group. Yes. So pre-tax grouping losses is what I was talking about. So if, say, company A formed part of the tax group in 2026 and it has the tax loss from the year 2024, that loss can only be adjusted against the attributable taxable income of company A, and it will not be adjusted against the rest of the group's income. I'm talking about the losses that that company had before joining the tax group. In 2026, if the company again has losses, that can be offset against the whole tax group. It is pre-group joining, that is pre-joining the group, what it had. And so that is something very important to see. And then if there are any foreign tax credits that have to be applied, again, the calculation of effective tax rate and the income will again be member specific. It will not be taken as a group level. So these are things that if you want to have benefits, and if tomorrow the subsidiary was to leave, any tax loss that it brought in before the forming the group, if that stands unutilized, it can be taken as benefit, but again at the company level, and will have to be carried forward at the company level. So in cases that you see that you will have foreign tax credits, or if you will have tax losses, it becomes super important that individual separate financial statements are maintained, so that appropriate disclosures and information are available tomorrow whenever you want to take the benefits. So there are restrictions on who can carry forward the losses, who will get the benefits if your company's group structure keeps moving. So it's advisable when you're forming the group that you still are able to extract your separate financial statements tomorrow to have these benefits. If we can go to a slide before, and I think I skipped that topic before this. Yeah. So any group member changes, as I said, will have to be applied and to be informed to the FTA within 20 business days. And it will always be effective from the first day of the tax period when it does not remain applicable. So if a subsidiary does not qualify, say in September loses the 95%, September 2025, and assuming that they follow Jan to December financial year, that tax period itself will, this company will not be treated. So it's not apportionment, it's not proportionate, the whole tax period. So even if in November you lose the 95% ownership, that tax group member will not be forming part of that group from the 1st of January of that year. That is presuming you follow Jan to December. And this moving out of one company of the group does not actually lead to any cessation of the company's tax group. This is a moving tax group is allowed. So the group will continue. It's only that that tax group member, that subsidiary, does not remain part of the group anymore. And it has to be informed to FTA, and application has to be made to change the tax group structure accordingly. And if a subsidiary ceases to exist, that is, it goes out of business, it has not left the group. It's not that the ownership has changed, but it ceases to exist. You have liquidated the company. So till the date it ceases, so that full tax period, till that period, that company will remain part of the tax group. And the tax group continues even if few subsidiaries cease to exit until the time that you have at least 2 members to qualify staying part of your tax group.
Just a question on the membership to be a tax group. On the FTA portal, is it quite a complicated process? Or because I know the VAT group registrations is quite complicated and quite finicky. How does that compare to the corporation tax registration process?
It's the same, because, and it's a little more complicated because in VAT what happens is that you need to just prove effective management and control, and it is not strictly about the percentage of holding. Here you will have to prove, if you have subsidiary structures, then the effective ownership and its trail has to be proved. So also you have to prove the residency of the company. So as far as the company's ownership, residency is through ownership, it's easier to establish. But there are options where your residency is not through ownership, but from effective management and control, and those documentations are a little complicated. So it's not about the application format, it's about, because the terms and conditions are complicated, the documentation and the trail is complicated. In cases where it is complicated, then it becomes, you have to be super clear with the structure, with your documents to establish.
Okay, no, thanks for that. We have 10 minutes remaining, so I think what we may need to do is kind of do another session on groups,
I
probably
think,
again.
yeah,
Just kind of,
we will
so
try
I think
and merge. Sorry, I'm cutting you, but then if you can just conclude, browse through next two slides. What I propose is that after this, we will do one session where we can connect the tax groups, qualifying groups, return filing all together, how they
yeah,
interact with each other. But I
yeah,
think we have covered the tax losses and cessation. It's okay. Yeah, we can take if any questions are there. The same rules apply for your what I've said for tax losses. Same rules apply for the general interest deduction. The limit remains 30% of the group level EBITDA,
yeah,
and pre-grouping interest again can only be taken benefit by the member in its individual capacity, same as tax losses. It cannot be brought to the group. That is the pre-group forming interest. Once you've joined the group, then all your interest benefits can be. But if there is any unutilized interest benefit from pre-grouping time, then it cannot be utilized for the other entities and stays specific to that member. And same is taking forward any unutilized interest, and exactly the same calculation individual company wise for the foreign tax credits. I remember I had have we covered the foreign tax credits that we will have to do the effective tax rate calculations?
no, we haven't covered foreign tax credits yet.
No, okay,
Um,
so once we cover
quite
that, this will make sense. Sorry.
Yeah, it's quite a complicated
Yes.
part of the law. Although it's just literally one line, getting to that number is actually isn't as straightforward, and the administrative part is quite complicated as well. Like getting the documentation to prove that you have that is quite important. And I think we can also cover situations where there isn't a double taxation agreement. What do we do then? Because, for example, we met with one client the other day, and they're based in Greece, and apparently
Mhm.
Greece, the double taxation agreement between Greece and the UAE has stopped. So we can probably talk about how that affects companies as well, in a
Yes.
sense, you know, what what's out there that they can do to kind of help mitigate that as well. So I think foreign tax credit is probably going to be like its
Yes.
own deep dive.
Yeah,
Um,
yeah, that would have
on-
to be done separately then. And I think in that case, we have covered mostly everything about the tax groups, practically what
yeah,
has to be seen into and how the tax groups are to be formed and what could be the implications. One implication that we are still awaiting is the requirement of the special purpose audit, the details of which will come out soon. So the new publication, which has come in just yesterday, I think the ministerial decision where they are saying that, interestingly, the earlier decision number 82 would be applying for the financial years commencing until 31st December 2024. Any financial year commencing 1st of January 2025, the new audit regulations will apply. And it remains, the 50 million limit remains the same, and the
yeah,
requirement for the qualifying free zone person remains the same. It's about the tax groups and what should be taken in case of foreign companies, PE companies, what revenue should be taken to consider is what is clarified there. So, yeah, it's interesting. It was expected. There was a lot of confusion how the tax groups will form their audited accounts. So, and also interestingly, though it's not covering our discussion point, they have said that there will be some special requirements for the companies involved in distribution activity through qualifying
yeah. I saw that as
from
well. Yeah,
the designated free zone. There would be some special requirements for the documentation of those. So it'll be interesting to see that what they add there for all the
yeah,
distribution companies from designated zones. Yeah.
yeah. Makes sense. We've got 5 minutes remaining, so if there are any questions that anyone have that myself or Rashmi can answer, feel free to put it in the comments. If not, then what we'll do is I'll ask a few questions myself, and we'll probably do a next session. We'll probably do a part two of tax groups, and maybe go into, as we mentioned, a few more topics within tax groups, such as foreign tax credit. We don't have any more webinars for this month, but we are going to be doing quite a few in May. So expect there to be about probably 2 to 3 webinars in May. If there is anything you want us to cover, feel free to message us directly on LinkedIn. And we're happy to cover some of these topics for you if you need. Obviously, with corporation tax deadline coming up 30th of September 2025, I don't think anyone's going to be having a summer holiday. Well, accountants won't be having a summer holiday, right? So you want to level up your knowledge as much as you can. That's what we're here for. We're here to help you level up your knowledge, to help you understand what's going on with the corporation tax. And if you need help, obviously reach out to Rashmi, who can definitely help you with any technical aspects that you need from that point of view. We do the calculations, we do the tax calculations, so you don't have to use Excel, you don't have to use Word. It's all automated, and that's what we're here to do as Taxstar anyway. No questions have been asked so far. I think from my side, it's very, very interesting to understand that there's lots of different aspects of a group that we need to take into consideration, especially as I said in the beginning, we have entrepreneurs that they set up 4 or 5 licenses without telling you, and sometimes you get certain situations where actually it's a group, right? But there's nothing you can do because they've told you quite late. And that's quite frustrating. So one of the things you do want to do is speak to your boss or your client and just make sure that they are always keeping you informed when they set up entities, because the other thing they forget about is the registration. If you don't register your company within a certain amount of time, you get a penalty straight away. And then they'll probably blame you in the end, right? Not them. So just keep that in mind. Okay, we have one question.
Sure.
What was you going to say?
I was saying that the important thing that you highlighted, it's very common in this part of the world that each group has a lot of companies and a lot of business. It's not just the individuals who are starting up. Most of the groups, business groups that you will form, they will have multiple companies, but the structure has never been thought about from the angle of how the taxation and reporting would apply to them and what compliances would be required. You're already a little late, but I think if not by now, I think it should not be postponed even for a day. And what should be considered is your group structuring, ownership. You will have all the companies owned by same people, but 51, 49, 29, 39 and all. There's no way you can form a tax group or take the benefits of group and offsetting your group transactions. And you will end up doing a lot of compliances without getting any benefits. So a group structure and its reporting requirements. We are very underplaying that how systems help you in maintaining records, how automation helps you. And because these records are to be kept for 7 years, you will have to know, okay, what was the transaction offset, what not, which was the subsidiary for my IFRS, which was the subsidiary for my tax group, where was the TP required. All this is, you have to use systems to get the reporting done, right? Yep.
Yeah, no, thanks for sharing that. We've got one question. I have a question regarding registration under corporation tax. Company A sell his business to Company B. Company A never took corporation tax registration. Now Company B, how can they escape from the 10,000 dirham penalty?
Okay. If we can ask a sub question to that, when you say sells the company, what does that mean? If you have acquired the license itself, then there is no change of ownership does not qualify for new registration, because registration applies to the company license. So it was the license which was supposed to be registered. So change of ownership will not change the obligation date of registration. Hence, the penalty will still apply. You cannot escape if it is not a new company formed. So selling of business would not help you anyways in complying with that. If the license number continues the same, I'm assuming you are acquiring the license and not just the business transactions.
Yeah, no, that's a good point. I would say from a M&A perspective, you should have a clause in your SPA when you buy the company to say that any penalties from the business that you acquired has been is deducted from the sale price, or
Yeah.
the owners pay for it as well. So if you've bought the company and they've got a liability, then and that happened prior to you purchasing that business, then obviously in reality that's not your liability, that's their liability. So you probably want to argue it from that point of view.
Yeah.
Cool.
Yeah, so
All
when
right.
you do compliance due diligence, I'm sure that it is again one very important thing that gets highlighted here is that when you're doing any transactions of acquisitions with the client, a compliance due diligence earlier was only from VAT angle. Now it will be from your corporate tax reporting angle also, that you do a compliance due diligence before you form any acquisition transactions or you do any such investment transactions with companies.
Yeah, so feel free to contact us if you need any specific sessions, and we'll be sharing this on LinkedIn. It will also be on YouTube. So if you need to recap or have a revisit, then feel free to do that. If you would like the slides, reach out to myself or Rashmi. We can share the slides with you as well. Have a great rest of the week. Enjoy taxing, and we'll see you next time. Take care, guys.
Take care.